Hello and welcome back, guys. So in this particular session, we are still continuing our question uh, on March 2020 model question, right? So how Quiver Co should be accounted for in consolidated financial statement at 31st December 20x4, right? So that's our year end anyway, right? So what does it say over here is that acquisition of Quiverco. So Quiverco was purchased with 100% equity interest. Okay, Hummingsco purchased 100% equity interest in Quiverco. Hummingsco made the acquisition with the intention to sell and therefore did not have an active involvement in the business of the Quiverco. Hummingsco immediately began to seek a buyer for Quiverco and felt that the sale would be completed by 31st October 20x4 at the latest. A buyer for the Quiverco was located in August 20x4, but due to an unforeseen legal dispute over a contingent liability and disclosed in Quiverco financial statement, the sale had not been finalized as at 31st December 20x4. The sale is expected to be completed by early 20x4, right? So in case of this, what does our IFRS standard basically say is that so first of all, what I'll do is I'll just give you the definition as well, okay? So a proper definition. So IFRS 5 non-current non-current assets held for sale and discontinued operation says that a non-current assets or disposal group should be classified. So non-current assets held for sale and discontinued operation says that non-current assets or disposal group should be classified as held for sale if its carrying amount will be primarily recovered, okay, or will be recovered primarily via sale, okay, via sale rather than continuing use, okay. So that's our first thing that we need to consider. Second thing that we also need to talk about is that basically if you want to give a disposal group, you can give it, but disposal group is basically a group of assets which could be a liabilities as well, like subsidiaries, CGU, right? So that the entity intends to dispose of in a single transaction, okay. So what are the conditions that should be satisfied in order to be classified as held for sale, right? The following criteria should be met to classify as held for sale, and the criteria are held, and then the criteria are basically let's just put in a bullet point, and then the item should be available for in present condition and in present location, right? So item should be available for immediate sale immediate sale in present condition. Second criteria is basically the sale is highly probable. Third criteria that we should consider is that management is committed to sale. An active program to locate the buyer is in place. The asset, let's not say asset, okay, the item is, because it could consider a group of assets as well, right? So which could include a liability, right? So it could include a disposal group, which could basically include that as well. So the item is being actively marketed. The item is being actively marketed at a reasonable price in relation to fair value, value. And then our last criteria is basically, not last, let's not say last, it's second last, okay? It is unlikely that the plan will change significantly, okay? Significantly. That's our second last criteria. And then our last criteria should be the sale will occur within 1 year from the date of classification, okay? And that's our last thing, right? So similarly, so let's just give that scenario as well, because in this case it has happened, right? So if the sale does not occur, and does not take place within 1 year, IFRS 5 says that an asset or disposal group, right? So says that it can still be classified as held for sale if there is again another bullet point, if there is sufficient evidence, if there is sufficient evidence that the entity is still committed to the sale. Second is the delay is stuck, okay? So the delay has happened, or the delay has been caused by unforeseen or unforeseen events or circumstance. circumstances, right? So clearly in this case what has basically happened is that see, as you can see, there was a legal dispute, right? In case of Quebeco, the management is committed to sale, or what is it? The management has active program, or the entity has, you could say, okay. The entity has active program to locate the buyer, has active program to locate the buyer. And there is an active program, and what else is there? Began to seek a buyer and felt that the sale would be it is probable that it would be sold within a year, and the commitment is there. So therefore it can be classified as held for sale. This is our first criteria, okay? So if you can see over here in our thingy as well, so application of the above discussion to Quebeco, right? So 4 marks. So has an active program, and then after that and then what has happened? Unforeseen legal dispute. Since the sale hasn't occurred during the period because of unforeseen circumstances. Just close this thing, exit, right? So the sale has not occurred during the period because of unforeseen circumstance, unforeseen legal dispute, unforeseen circumstance, that is legal dispute, and the management is still committed to the sale. The management is still committed to sale. So it satisfies the criteria of being classified as held for sale, even though the sale did not take place. place within a year. So if you write this much, you should basically get the marks. Okay, so not slave, man. Why are you suggesting me slave? So similarly, what if the sale does not take place, right? So what I will do is I'll just give you a bit of idea in this other thing as well, which is basically regarding if the sale did not take place and if it did not meet the criteria. Okay, so if the criteria for held for sale is not met, then the entity should cease to classify it as held for sale. Right. After this, now comes the crucial part. Okay. Now comes the crucial part. So in this case, what we should do is that the assets or disposal group should be measured at the lower of. So what lower of? Lower of few things. Okay, few things such as its carrying amount before it was classified as held for sale, adjusted. So its carrying amount before it was classified as held for sale, which is adjusted for any depreciation, or depreciation, you could say amortization or revaluation that would have been recognized had it not been classified as held for sale, right? So classified as, because you are not using it, so you are not depreciating it basically, so you will also have to basically measure it at the lower of carrying amount for if it was classified as before it was classified as held for sale, and then any adjustment for depreciation and all that, right? And then, or it should also be measured between its recoverable amount. Okay, or whichever is lower, that what basically it means, right? So recoverable amount at the decision date, recoverable amount on the date when the decision to not sale takes place. Okay, that's what basically we should be doing. So if it had not been qualified in this particular circumstance, then we must have mentioned that thing. Okay, so how the treatment should have been occurred. Okay, so that will be very crucial. So since in this case it has met the criteria, so we can just say it satisfies the criteria, so basically it's just continue as it is, right? So if it had not, then we would have required a different accounting treatment as well, and we must have explained it. Okay, so I don't know if you will be given marks, I mean if you will be required or not, but I would basically be doing it. Okay, so in this case, so it's just application of that above, right? So similarly, what's our next requirement? So calculation and discussion of how the bond should be accounted for in the financial statements of Humming's Co. as at 31st December 20x3 and 31st December 20x4, including any impairment losses, right? So what has happened to our bonds? So on 31st December 20x3, Humming's Co. purchased 10 million $5, 5% bonds in Steveco at a par value. The bonds are repayable. So what is this? Basically investment in investment in bonds, right? Or you could say financial asset as well, right? So the bonds are repayable on 31st December 20x6, and then the effective rate of interest is 8%. Humming's core business model is to collect the contractual cash flow over the life of the asset. Okay, so in this circumstance, what we should be basically talking about is that basically since its business model is to hold it, right? So what does our question basically say? Calculation and discussion of how the bond should be accounted for in the financial statements. Calculations and discussions, right? So in such circumstance, what we should be doing is that I'm just checking if we need to explain the criteria or not, okay? Okay, first thing first, let's just write that point down. The business model of Humming's Co. is to collect the contractual cash flows over the life of the assets. Thus, it should be measured at amortized cost. Initially, it should be recognized as per IFRS 9. IFRS 9, it should be recognized at fair value initially, and then that is, in this case, how much is that? $10 million, right? Isn't it? $10 million, I think so. Yep, 10 million. So $1, 1 to 3, 1 to 3. Mr. Zero over here. So 1 2 3 4 5 6 7, right? So that's pretty much our amount is. And after this, what also happened is that, so let's write down the requirement, okay? I'll just write down the requirement as well. IFRS 9 says that loss allowance must be recognized for financial assets that are debt instruments and which are measured at amortized costs, or at fair value, or at fair value through CI, right? Or at fair value through CI. So what does this particularly say is that basically if the credit risks on the financial asset has not been increased or has not increased significantly since initial recognition, the loss allowance should be equal to 12-month expected credit losses, and whereas if it has increased significantly, then loss allowance should be equal to the lifetime expected credit loss. All right, so that's our requirement. And then what else has happened over here? So it's considered to be low, right? Okay, for the first year it is low. Since the credit loss in the period for the year ended 31st December 20x3, 31st December for the year ended 31st December 20x3. What has happened? X3 the credit risk has not increased significantly, so only credit loss or loss allowance, so only loss allowance for the 12-month expected credit losses recognized. The 12-month Expected credit loss. Expected credit loss is defined as a proportion of the lifetime expected credit losses which represent the expected credit losses which results from default within the next 12 months. So what does our question basically say? What's that? Expected credit loss are from default within the next 12 months, right? It is often weighted or by the probability of a default occurring, right? In case of humming score, it should recognize loss allowance of $10,000 as at 31st December 20x3, right? This will be expensed to SOPL and a separate allowance created rather than offset against the $10 million bond. Okay. On SOFP, it will be netted off. So carrying amount of $9.99 million. Okay, so which is basically $10 million minus your $10,000, $10,000. Will be reported. So similarly, as the bond is measured at amortized cost, and amortized cost table should be prepared, right? So first of all, let's just prepare it. Okay, so balance forward, next is interest, next is coupon, next is carried forward, right? Already. So similarly, balance forward in this case is $10, comma, or what we could say is comma, right? So what I'll do is I'll just bring this thing down so that I can see it more clearly. Okay, so our interest will be 8% of this, right? So 800,000, I think. 800,000, right? So 1 crore and then 8%, yeah, 800,000. 0, okay, so 800,000, and then our coupon rate will be 5%, I think. 5%, 5%, yeah. So 500, comma 00, right? And our closing balance will be this figure plus this figure minus this, right? So 3. So that means dollars, same thing. Okay. Okay, I'll have to do something else. So coupon rate is that much, right? Okay. Yeah, so after this, I'll just change this one. So 1, 2, 3, 4, 5, right? So it will be 10.3. So that will be our figure, right? At that particular date. So let's just explain it above as well. So amortized cost should be prepared, right? So the effective interest rate of 8% should be recognized or should be included in SOPL and added to the bond, and the coupon rate should be deducted from the carrying amount CA. Okay, and the loss allowance of $10,000 will not affect the carrying amount. Okay, carrying amount will not be basically be affected. Okay, thus the bonds would have a carrying amount of $10, 300 or 300, comma at 31st December 20x4. So it will basically have that thingy, right? Yeah, that's pretty much it. So in the initial year it was that much. Okay, it was issued on that particular date itself, nah? That's why. And then it will be carried at 10 lakh or I mean 1 crore 3 lakh, right? So at this date, before considering the impairment allowance, that's one thing. And then last but not the least that we need to talk about is at 31st December 20x4 what has happened? So for the next 12 months 10,000 has been already thingy and done, right? So did we subtract it, by the way, on that date? Yeah, we did. Okay, good. That's good. That's what I was looking for. Okay. So after this, it has increased significantly, right? The credit risk has increased significantly. Secondly, thus, as per IFRS 9, what should happen? The difference between the assets carrying amount and the present value of the estimated future cash flows present value of the expected loss and contractual cash flows as weighted by the probability. Okay, probability. So what will basically happen is that the expected credit loss is discounted using the original effective interest rate. So what will happen basically in this case is that effective interest rate of 8%. So in this circumstance, what we will do is let's just write the date first of all, and then cash shortfall. Shortfall cash. Present value of default. Right. So what we've been given is that 31st December 20x4, 20x4, and then 31st December. Or what I could do is just write TEC, okay, and December 20x5, right? So in this year, what does the question say? So present value of the repayments for the year ended were estimated to be this much, right? So our present value is already been given. Otherwise, if we had not been given, what we would have done is that we would have first of all brought it into present value, and then after that charged a percentage of that, okay, or charged or weighted by its probability. That's what we would have basically done, okay. So after this, what we will do is, what's our probability? I mean, our number 462, and then probability of default is 3%, right? So $462, comma 963 into 3%, right? So what will be our present value of default? 462, 963 into 0.03. So 13889 dollar 13889, right? That's our shortfall for that. And then over here in the second question, what's our shortfall? So in this case, it is 6858710 dollars, 6858710 into how much percent is that? 5% likelihood, right? 5%. Only a portion of the nominal value of the bond should be repaid, and the present value of that is this much. Right. So in this case, what we will be doing is, let's bring this to present value, okay? Into 5%, right? 324,936, 342, 936, 342, 936, 342, 936, right? That's our value. So what will be our total then? It will basically be 342,936. That means 356,825, right? This is our present value of default, right? So we will need to, so that's that. And then since $10,000 has already been recognized, the loss allowance should be increased to dollar 356,825 with an expense of dollar 346,825 in SOPL, okay? SOPL. Next thing that we need to do is basically subtract it, right? So it is subtracted from the carrying amount. assets, and then present value of expected loss. And that is that, and that is that, right? So it should be subtracted from the carrying amount. And then after that, what we need to do is subtract it from the carrying amount or from the assets gross carrying amount. Gross carrying amount of gross carrying amount. Therefore, in SOFP or on SOFP, carrying amount of bond will be or would be, let's say, would be dollar blah blah. So this will be basically dollar 10 comma 300 comma, that's our last figure, right? And then from here what we subtract is we subtract this particular figure, control V, right? So 3 lakh something is gone, that means 46 will be subtracted from 10 million. So minus 46 825, so 99 9,953, 175. So this is the figure that will be reported in our books of account. Okay, so yeah, that's pretty much it. So all you need to remember is that basically the treatment will be a bit different for two different things. So the basically the top one is pretty simple, right? So when you're basically changing it to held for sale, what we need to remember is we have a certain criteria that should be met, and if it does not take place within the year, then due to following reasons, then it can still be classified as held for sale, which are basically there is sufficient evidence that the entity is committed to sale and then the delay was due to unforeseen circumstances. Okay, so suppose if it did not meet that criteria, now it cannot be classified as held for sale. What we should do is basically it should be measured at lower of the carrying amount, which should be adjusted for depreciation, amortization, any other adjustments, right, or revaluations that would have been recognized if if it was not classified as held for sale, right? Because all these things had stopped because we had classified it as held for sale. So similarly, second thing is basically it's a recoverable amount, so we need to basically measure it at carrying amount and recoverable amount. Okay, so carrying amount is basically adjusted for depreciation, revaluations, or amortization, any other adjustment, right? So that's what we should be doing, and then just saying it, just explaining that particular thing. So in case of number B, what we need to remember is that, so basically in case of financial asset impairment, what we need to remember is that basically on the date of inception as well, we need to create an allowance, must be recognized, right, for debt instrument, which is basically measured at amortized cost or fair value through OCI. And then if the financial risk has not increased, then only loss allowance should be equal to the 12-month expected credit loss. If the credit risk has increased significantly, then the loss allowance should be equal to the lifetime expected credit loss. Okay, that's pretty simple. So since in this particular case, it was deemed that during the first or during the date of initial recognition that credit risk won't increase significantly. So that means it has not basically increased, right? So only a 10,000 loss allowance will be recognized, which is basically your 10 million is your issue, and then minus 10,000, which will be basically 9.99 million, right? So that's your figure. And then next thing what has happened is basically, since it is measured at amortized cost, what we do is we create an amortized table, and based on that we charge interest to SOPL. Coupon rate will reduce that carrying amount, right? And then the 10,000 of allowance will not affect this particular figure, okay, will not affect the carrying amount. And this is for 31st December 20x3. Whereas in case of 31st December 20x4, what has happened is that the credit risk has increased significantly, right? In such circumstances, what does IFRS 9 basically say is that it should be deducted from assets gross carrying amount and the present value of the expected losses in contractual cash flows, which is weighted by the probability, okay, which is weighted by the probability. So basically our shortfall is in present value over here is this much, for this year is this much, the probability is this much. So if you multiply this and this, you will get a present value of default is this much, and then when you add it up you get this much. So since we have already recognized a loss allowance of 10,000, all we need to do is just increase it to 346, right, 825. So after that, what we do is at the end of the period, we basically subtract the assets gross carrying amount, and then okay, over here, see over here, what I did was a bit of mistake over here. So it should have been subtracted by higher figure. Okay, so 356 should have been subtracted. Okay, so loss allowance of 356 should be increased to 356. So 1030 minus your 356 is your carrying amount that will be reported on 31st or 30th December 20x4, okay, for that particular year. So this is how we basically account for impairment of bonds and IFRS 5 kind of thing, which kind of assets to be held for sale, right? So that's it from my side for the day. It's getting a bit long, so I'll see you in the next question in next video. And yes, please don't forget to share this video with your friends, family, whoever is studying any ACCA kind of course, right, or IFRS. So until next time, bye bye, enjoy your day.